I bet you're using the fixed range volume profile incorrectly, and because of that, you are leaving a lot of money on the table. But don't worry, in today's video, I will show you very simple and at the same time very effective method how to use the fixed range volume profile. The fixed range volume profile measures specific sections that you choose directly on the chart. It can be the start of the day to the end of the day, the beginning of the certain range to the end of the certain range, or you can even measure just 2 candles. However, the real question is, which section should you measure to use this tool effectively? A very effective strategy that has worked very well for me over the past few years is measuring the last 2 waves. Price reacts to previous wave areas. This means that once the price moves upward in impulsive wave, the wave that follows will react to the value areas of the previous wave. These value areas from the previous wave can then be used as the key levels, the big picture, from which can we enter trades on the smaller picture, meaning lower time frames. And once we measure the second wave, we will establish the counter levels that will be used as the take profit targets. That will give us a clear picture from which point to which point can we trade. So we are trading from the previous high volume nodes of the previous wave to the high volume nodes of the current wave. So let's jump to ADAS and I will show you how to apply this theory in practice. In ADAS, open the fixed range volume profile and set a period to custom. Choose the time frame based on whether you are scalper or day trader or swing trader. I'm primarily an intraday trader and scalper, so for this video I'll be using the 1 hour chart, which is best chart for high time frame key levels for intraday setups. For scalping, good time frame for volume profile is 30-minute, 15-minute or 5-minute. And now, how do we define a wave? A wave is an area of consolidation followed by an aggressive sell-off or rally. The wave ends the moment balance returns to the market and new consolidations begins. So each consolidation followed by an aggressive sell-off or rally is one single wave. So in this case, we can consider this consolidation up here along with this aggressive sell-off as a one wave, which will be wave for our key levels. This will be the start of my range. I'll measure it using these 2 anchor points, and the profile will then appear on the left side. Down here is new consolidation, new balance, which means start of the new wave. Once we extended the range to the start of the second wave, the profile will factor a new value area, new volume node. This is the start of the new wave that's still forming, so I'm going to extend the end of the fixed range volume profile to this second wave. And our objective is to trade from the prior wave's value area, or high volume node, into current wave's high volume node. As the price pulls back to those old value areas, I'm going to drop down to lower time frames to check the order flow. And the key thing I want to see here is absorption. In this video, I won't be covering the specific absorption patterns because I have plenty of other videos on my channel for that. I have the whole playlist of live trades where you can see absorption in live action, so if you are interested, I'll leave you a link to that playlist in the end screen of this video, or you can check it out right here. So, once absorption appears in these areas, our goal is to trade the move between these 2 value areas. In this case, the upper value area from the previous wave will act as a key level for short entry, again only if there is absorption, and the value area of the current wave will then serve as our target. By measuring the last 2 waves, we are utilizing the market momentum. It's clear that if traders sold aggressively in the latest wave, they are still present at their volume areas and will defend them. This is exactly what the absorption will confirm for us. Essentially, we are reactive traders. We trade the order flow reaction to the prior value areas that drove the initial sell-off or rally. So, that's the theory behind trading the fixed range volume profile. However, practice is much more important. That's why we are moving on live examples, where I will show you how all this works in real markets. You will find all of that in this playlist, so see you there.